All right, good morning, everyone. Welcome to the weekly meeting. For those of you that might be attending this for your first time, this is a meeting we have every Tuesday to talk about some kind of real estate or prepping for your real estate exam type of topic, something that's applicable to everyone. And today we get to talk about something that's very near and dear to all of our hearts. It should be. It's something that a lot of us are scared of. We're just like, oh, it's just too much. I'm just not even going to bother. I'm just going to hire somebody to understand it for me. But as real estate professionals, as real estate investors, really as just citizens of this country, we should understand this topic we're going to be talking about today. So without going any deeper into it, I'm going to hand it over to Nick.
Thanks, Zor. Yeah, I agree. This should be on everyone's radar. Most Americans don't know how much they spend in taxes. They just trust their employer to withhold a certain amount, and then they're stoked when they file their taxes to get a little bit back. But they don't know that almost half their income, in a lot of cases, more than half their income is being spent in taxes. So if you think about that, you're working 6 months out of the year for the government, which is absurd. I don't know about you all. I've spent enough time working for the government. I'd like to keep as much of my money as possible. So anyway, let's go over how to make that happen. Let's see, I'll go to share screen. Do I have, let's see. Do I have that ability yet, Zor? Yep, here we go. Share screen, screen 2. All right, is everybody seeing, yeah. Everybody seeing a pumpkin? Yep, okay, good. All right. Real estate tax, fundamental concepts and strategies. This is by far the scariest subject in real estate, so it's pretty fitting we're going over it on Halloween. I totally ran with that theme. I hope the images aren't too scary for anybody, but I definitely had some fun generating these. All right. It's also fitting because starting today, you have about 2 months to implement these strategies. Okay. So we intentionally went over it now as opposed to later to give you some time to use these. We don't want you to just walk away from this presentation not having done anything. We want you to actually go get a CPA, go employ these strategies in the next couple months, and hopefully save yourself a few $1,000s. Something to note is the U.S. tax code and strategies to avoid them are very, very complicated, much too complicated for us to go over in just 30 minutes, okay? Or really even 30 lifetimes. So we're going to break up this presentation into 2 parts. First, today, we're going to go over the key terms and concepts, okay, that are important to understand. And then next week, we'll dive into the strategies. We'll build on those key terms and concepts on how to use them to lower your tax burden. Okay, so it's a 2-parter. Disclaimer, I am not a CPA, all right? I am not a lawyer. I am not your accountant specifically, okay? So consult with a CPA or a tax lawyer before employing these strategies, all right? These are general strategies, but everyone's taxes are individualized, so they may not work for you. In fact, they could get you in trouble depending on what state you live in or how you employ them, okay? Though federal taxes are true for anyone federally, right? State, county, and city taxes can vary hugely based on where you live. Just ask anyone who lives in California like me. So again, consult with a local tax professional. I can't overemphasize that, and you'll hear it again through this presentation. It's a general theme, okay, to be sure you're not breaking any local laws or just neglecting state, county, and city taxes, all right? Federal taxes are typically what people pay the most attention to, but you can also save yourself a ton of money employing strategies to avoid state, county, city taxes as well, okay? So next slide. All right, don't put the cart before the horse, okay? This is really important. I was on a call 2 weeks ago with a tax lawyer who wanted to charge me $5,000 for a tax strategy session. And I was like, I don't make that much money for $5,000 to be justified. I would be paying you more than I would be paying the IRS. So it doesn't really make much sense, okay? it takes money to save money. All right. Let these strategies guide you on how to spend your money and help you keep the money you earn, but understand that the priority is still making money. Don't avoid making money in order to not pay taxes. That would be ridiculous. Okay. Next is find a CPA who doesn't cost more than what you would spend on your taxes. Okay. You want to find a professional in that Goldilocks zone. Okay. Somebody who's going to do a good job, but also not cost you more than what you would spend. Okay. That would be kind of ridiculous. All right. Key terms and concepts. All right. Biggest one, tax evasion versus tax avoidance. Okay. This is what'll keep you out of jail. All right. Tax evasion is when you illegally hide income or misreport information to pay less tax than what you truly owe. It's against the law and can get you into big trouble, like fines or even jail. Okay. This is defrauding the government and you don't want to do it. Okay. Everybody loves the example. This is what got Al Capone, right? This is no joke. You can go to prison for defrauding the government for tax evasion. So don't do it. There are enough legal tax strategies to not pay taxes for most real estate professionals. Honestly, we'll go over how it's an extremely advantaged job later on. But yeah, you shouldn't have to do any tax evasion in order to avoid paying taxes. You want to stick with tax avoidance. Okay. That is to legally plan and organize your finances so you owe less taxes, taking advantage of the tax breaks or loopholes that the law allows. That's important. The IRS created these. The IRS publishes, okay, these laws and tax codes for you to use. Okay, so use them. All right. Don't end up like this confused zombie inmate. Stick with tax avoidance, not tax evasion. All right, burden of proof. All right, this is another important concept to understand, another legal proof or another legal concept. And it's why savvy business owners keep all of their receipts. Okay. When you submit a tax claim, you're painting a picture for the IRS explaining why you only owe X amount in taxes. All right. If there's too many incongruencies in that picture, it doesn't make sense to the IRS. They will audit you. Okay. There's multiple types of audits, some more severe than others. Some can be really bad. But that's outside the scope of this presentation. So what we're going to do is just say you need to keep that proof. In other words, keep your receipts and be able to prove what you claim. All right. Don't make any outlandish claims on your taxes that can't be backed up with proof. All right. And as always, talk with a good CPA. This is what they do for a living. They should be up to date on the best practices. All right. The IRS doesn't publish their criteria for what triggers an audit. Okay. But a good CPA who looks at tax claims all day, every day, this is what they do for a living. They see what gets audited and what doesn't get audited. Okay. So they should have a decent idea. Okay. Moving on. All right. Why does it matter to you? Obviously, the biggest reason is you want to keep more of your own money. And you might be thinking like, oh man, I don't make enough money for it to matter to me, for me to be taxed really heavily. You probably do. You're probably just paying more in taxes than what you realize. Even if you only make $50,000 a year, you're going to be paying $5,000 ish in income tax. That's $5,000. That's huge. If you make $100,000, you're going to be paying $10,000. So let's minimize as much of that as possible. Okay. As I said earlier, it's estimated that between all levels of government, the average American pays half their income to taxes. That's too much. Okay. Keep as much of that money as you can. The next reason is help clients keep more of their money. That's huge. You're not a CPA and you're not a tax lawyer. Okay. That needs to be set up front. You can't do their taxes, but you can teach your clients important concepts like 1031 exchanges, primary residence exclusions, or buying properties in opportunity zones. Okay. And that could potentially save your clients thousands of dollars. And they're definitely going to come back to you as a real estate agent if you're providing that much value to them. Okay. So you can help your clients out in so many more ways than just getting them a good deal on a house. All right. Next, work with tax savvy investors. Okay. If someone comes to you and they're saying, hey, I have 45 days to identify a like property. And you're like, what does that mean? You just lost a client. Okay, they're not going to want to work with you if you don't understand the ins and outs of the 1031 exchange that we mentioned earlier. So understanding these concepts and being able to speak intelligently about them could win you clients in the future. Income taxes. This is the big dog. This is what gets most attention, but it's also the easiest to lower. All right. Typically, when people talk about income tax, they're talking about the federal income tax. But most states, not all, but most, also tax income, and even some cities like New York tax income as well, which I think is insane that your income can be taxed 3 times. All right. It is a tax on individual and corporate earnings as well. And like I said, it's the federal government, state governments, and some cities. All right, capital gains tax. This is a tax on the profit you make when you sell something like stocks, real estate, or other assets that has increased in value. So as an example, let's say you buy a home for $100,000, it sells for $150,000. That $50,000 difference you made in profit will be subject to capital gains taxes if you don't employ the strategies that we're going to talk about next week. Right? Short-term capital gains, assets you've owned for less than 1 year, are normally taxed at the individual's income tax level, which we'll go over in a minute. Long-term assets you've owned for longer than 1 year are capital gains normally taxed at a lower rate. So if you hold it, there could be a benefit to actually holding on to an asset for longer than a year. Okay? Levels of taxes. Up top, we have the federal government. Like we said earlier, they have income tax, capital gains tax, payroll tax, and so many more. The list of taxes from the federal government is extensive. It just keeps going. I can't name them all in one presentation. State government, typically income tax, sales tax is the big one for state governments. Excise tax, that's going to be like liquor taxes and cigarette taxes, things like that. License taxes, etc. There's a lot for state taxes as well. County taxes, that's normally property tax or special assessments. City taxes, some have income tax. I learned that creating this presentation. That is crazy. Then we have sales tax, property tax, and rental income taxes. So on your short-term rentals, your Airbnbs, they typically bring in a lot of revenue as well. And again, like I said earlier, this is a big reason why people pay over half their income to taxes and don't realize it. It's because you get nickeled and dimed at each of these levels. Okay, so we're not just going to go over the how to avoid paying income tax. That's how most people do it, and that's the big one. We're going to go over county and city and state as well. Okay. So the state tax rates can vary greatly. So let's look at a chart showing where your state stands. All right. Take a second to find where you want to live. If you're getting out of the military and trying to pick a state, I highly encourage you to investigate the taxes in that state before you move to it. Okay. It could make a big difference on where you want to live. States with no income tax: Alaska, Florida, Nevada, South Dakota, Texas, Washington, Wyoming, Tennessee, and New Hampshire. Okay, those are huge. States with the highest tax. Number 1, California, my favorite. Love this state, hate the taxes. Hawaii, sorry, Zor, you're number 2. Yeah. Next is New Jersey, Oregon, Minnesota, District of Columbia, not a state, but still worth a mention. New York and Vermont. Okay. So we're going to go over strategies on how, if you live in some of these really high income tax states, you can minimize that tax burden as much as possible. All right. Gross income. This is going, or excuse me, real estate professional. This is going to be important later. The IRS essentially gives a special status and benefits to those of us who work in real estate. All right. And it's pretty easy to meet this criteria if you are a real estate agent, but it is important to notice that just having your agent license or broker license doesn't qualify you. Okay. What does qualify you is meeting this criteria. You have to spend more than half your time, all right, doing real estate related activities, all right, materially participating in real estate income producing activities, and you have to work 750 hours a year in that area, which sounds like a lot, but it's only 15 hours a week, which is less than a part-time job. But if you work 15 hours a week in real estate, that means you can't work more than 15 hours a week in any other profession. Okay. So this has to be your primary or primarily how you spend your time. Even if you make more money in real estate than you make in your other profession. Okay, so this second one can make it really hard to qualify as a real estate professional if you have another job, like being in the military, even if you have your real estate agent license and make more money in real estate. Okay, next is gross income. In terms of taxes, gross income refers to the total amount an individual earns before any deductions, exemptions, or adjustments are made. It encompasses various forms of income. All right, here's all the example: wages, salaries, tips, bonuses, commissions, income from businesses or self-employment, etc. Any money that comes into your possession. All right, if you make that money, it's considered gross income. Doesn't matter if you saved it, spent it, invested it, however, if you gained it, it's gross income. All right, next is adjusted gross income. It's one of my favorite of the images. It's a monster that just got adjusted at the chiropractor and now he's all happy. So anyway, this represents an individual's total gross income minus specific adjustments. Adjusted gross income is important because it is used to determine how much of an individual's income is taxable and serves as a starting point for calculating a person's tax liability. It's used in actually a lot of calculations for someone's tax burden. So this can be really important. We're going to go over the calculations later. All right, but we're going to see the terms first. Next is taxable income. This is the amount of an individual's or entities' income that is subject to taxation after all allowable deductions, exemptions, and adjustments have been subtracted from the gross income. It's essentially the portion of one's income that will be used to calculate the final tax liability. Basically, it's the bottom line for an individual's income taxes, all right, for state and federal. All right, here is how they stack up. All right, you have AGI versus taxable income. It is a little oversimplified, but we're going to complexify it in a minute. All right, we start with gross income, right? That's all the money that came into your possession that year. We subtract adjustments, which is defined on the IRS's website and the tax forms. Okay, that gives us our adjusted gross income. From our AGI, we subtract more deductions. Okay, that's going to be your business expenses and whatnot. And that creates our taxable income or our bottom line. Okay, so now let's, like I said, complexify that and we'll look at it on the actual form 1040. All right, so this is the form where you will, well, this is the bottom half of the form where you will report your taxes. All right, this is probably the scariest slide in this presentation, to be honest. So as you can plainly see right here, lines 1 through 8 are your sources of income. All right, those are added together. That gets line 9. Okay, that is your gross income. All right, line 10 then summarizes your adjustments, which you actually list out on another form. Okay, and then line 11, all right, is line 9 minus line 10, and that creates your adjusted gross income. Okay, or AGI right here. All right. Then lines 12, 13, and 14, okay, those are all of your deductions. Line 14 is 12 and 13 combined. Then we subtract lines, excuse me, I lost it. Line 15 is your adjusted gross income. And line 15 is your taxable income. So we take our adjusted gross income, we subtract our deductions, and that gives us line 15, our taxable income. Okay, so yeah, not that complicated, right? All right, ways of reporting income. You're probably wondering how the IRS knows how much money you make. Well, it's because you and your employer will tell them if you're both law-abiding entities. All right. And you'll use these forms, W-2, W-4, Form 1099, and Form 1040, what we just looked at. All right, first, W-2 and W-4 income. The W-2 is the form your employer gives you at the end of the year. All right, it shows how much money you made from your wages or salary and how much money was taken out for taxes and other deductions during the year. All right, W-4 is the form that you fill out when you first get to the job to tell them how much they should withhold. Okay. And now let's move on to 1099. This is the form you will fill out as a real estate agent. Okay. This is income you earn from sources other than a traditional employer, such as freelancing, consulting, or other contract work. All right. It's where you report your commissions, and it shows no income tax was withheld. And that's really a key concept to understand that'll keep you out of hot water when it comes to paying taxes as a real estate agent. Your normal employer, all right, so like the military in the past, has been withholding taxes throughout the year to be paid to the IRS, and then you get a refund. But with real estate agents, that isn't necessarily done. Okay. So what that means is at the end of the year, you could owe a lot in taxes. So you need to be withholding those funds so that you have the money to pay them after you file or when you file. All right, ways of reducing your income tax. All right, here's the thing everybody likes to talk about: deductions, adjustments, tax credits, and exemptions. Adjustments, someone else going to the chiropractor. If you can tell, I have back problems. I really like chiropractors. All right. A specific reductions from gross income that determines adjusted gross income. All right. This is also known as above the line deductions, not to be confused with deductions, right? Super simple. All right. Here's some examples: health savings account contributions, self-employed retirement contributions, self-employed health insurance, et cetera, et cetera. There's a long list of these, but there's a separate list for adjustments and deductions, which we'll go over later. All right. Next is exemptions, okay? This is a set amount you are allowed to subtract from your total income before calculating how much tax you owe. The idea behind an exemption is to recognize and account for the basic cost of living, all right? Examples of exemptions would be dependents, veterans, senior citizens, and education-related expenses. The most common one is your children, but any family member that depends on you could be considered an exemption, okay? However, there was a tax act, which we're not going to go over the politics of, for the years 2018 through 25. The Tax Cuts and Jobs Act suspended the exemptions. Okay, so until 2025, these won't do you any good. So don't count on those in your taxes. All right, next is deductions. This is the big one. This is what most people use to minimize their income tax. All right, this is an amount subtracted for your adjusted gross income to decrease your taxable income. Could be standard or itemized. All right, common examples for real estate agents are business expenses, seminars and workshops, legal fees, license fees, office expenses, Wi-Fi bill, property repairs, insurance. Business expenses is the big one. You can write off so much saying it's a business expense. My favorite example is my wingsuit. I ordered a wingsuit this past year. It's got my company logo on it. It's advertising. And I'm not the only wingsuiter to do this, not by a long shot. We put our logos on our skydiving rigs, our helmets, everything, because that makes it advertising. Now, we don't report that on our taxes as a wingsuit, right? Because we're trying to paint that picture for the IRS. We call it an advertisement, okay? Because it is an advertising expense. I fully expect to get clients at the drop zone who see my awesome wingsuit, all right? So yeah, you can argue for just about anything to be a business expense, but you need to be able to, like I said, paint a good picture for the IRS so that they don't audit you and say, like, what the heck, a wingsuit? Like, that's not related to real estate, right? And a good CPA is what's going to help you paint that picture and know what you can reasonably deduct, okay? But you can get really creative with this. You can deduct all kinds of crazy things, right? There's a lot of apps out there that can help you keep track of your deductions. My favorite is Keeper. That's what I have on my phone. And contrary to popular belief, you don't have to keep the receipts for everything to claim it on your taxes. You only need to produce the receipts if you get audited. Okay, so that's another really important thing to note. So do keep them, but if you lose a receipt for something and you still want to claim it on your taxes, like, it's not a huge deal. All right, tax bracket. Okay, this is the ranges of income that are taxed at different rates. As your income increases, the amount of income within each bracket is taxed at a progressively higher rate. Okay, this is an important concept to understand as we go through income tax. All right, so imagine income as a set of stairs. Each step represents a different amount of income, and each step has a higher specific rate at which it is taxed. The higher you go up the stairs, the higher your tax rate. Okay, but that brings us to another important concept to understand, and that is the progressive system. Okay. As you go up those stairs, all right, you don't just pay the rate at the top step. All right. You pay progressively as you go up. Okay. So not all of your income is taxed at the same rate. The first step or the first bracket has the lowest rate. As you earn more and climb the higher steps or move higher in the brackets, that portion of income is taxed at the higher rate. Okay, so just to give you a hypothetical example, let's say the first bracket is $10,000, and that is taxed at 10%. Okay, the bracket between 10,000 and 20,000 is taxed at 20%. Okay, if you earn $15,000, your first $10,000 will be taxed at 10%. Okay, the next $5,000, or what was in that second bracket, will be taxed at 20%. And then if you were to go to bracket higher, that portion would be taxed at the next percent, et cetera, et cetera. Okay, so we'll go on to another example here, or metaphor. All right, imagine you're filling up a series of buckets with water or your income. Each bucket represents a different level of income, and each bucket has holes of different sizes, tax rates. The first bucket has tiny holes, so very little water or money leaks out. That's this guy. Okay, as you fill up and move to the next bucket, the holes get bigger, so a bigger portion of the water or money you pour in leaks out as tax. By the time you reach the last bucket, the holes are much larger, so a significant portion of the water or money you pour in will leak out as taxes. Okay, so you fill up this bucket, you move on to this bucket. All right, you lose some money in this bucket, you lose more money in this bucket. All right, and then as you fill up this bucket, you lose even more money. Okay, but you're not taxed at just the highest rate, as some people believe. Okay, so you're probably wondering, what does an actual tax bracket look like? Well, here you go. This is the 2023 federal tax bracket. Okay, as you can see, as you make more money, all right, you are taxed higher and higher, but you're only taxed on this portion, or you're only taxed at this rate at this portion of your income. And then as you grow higher, you're taxed a little bit more for this portion, and then you're taxed a little bit more for this portion. Okay. Next, tax credits. This can be a big one if you are a real estate professional. All right, it's a direct reduction of the amount of taxes owed. Unlike deductions and adjustments, which reduce the amount of income subject to taxation, tax credit gives you the actual dollar for dollar amount. Okay, so it's like the IRS putting money in your pocket. Common examples for real estate professionals, all right, rehabilitation energy and renewable energy tax credits. This is putting solar panels on your house. Okay, work opportunity tax credit. This is giving employment or providing employment to protected groups such as veterans, right? Low income housing tax credit. This is providing low income housing. And historic preservation tax credits. This is operating a business or renting out historic buildings. Okay. The government wants to incentivize these behaviors, so they will literally pay you to do it. All right. Self-employment tax. This is a big one. We're not going to get into the weeds on this one, but just know that you will be paying this as a real estate agent. So stand by, and we'll go over ways to minimize it later. All right. Here's the explanation for why that is on irs.gov. All right. Next is the calendar versus fiscal year. Okay. This is a big benefit of being self-employed and owning an LLC, S Corp, or C Corp. Okay. Is you can determine what period of time you want to pay taxes for, which can be huge. We'll go over the benefits of that in our next week's presentation. But just know that that is an option. You don't have to file taxes for just the January through December, like a normal individual. All right, next is a loss. This is pretty self-explanatory. It's when you lose money. Either it gets stolen, you sell stocks at a loss, et cetera, et cetera. We'll go over how to maximize those, or how to use this as a strategy later. All right, here's one of my favorites, active versus passive income. This really backs up the theory that our founding fathers all owned real estate and they wrote the tax code to benefit themselves. Passive income, like real estate income, like rental homes, is taxed at a lower rate than active income, which is awesome if you're a landlord. Maybe not awesome if you're working a W-2 job, like we talked about earlier. Okay. So we'll talk about how to leverage this, how to convert maybe active income into passive income and be taxed at a lower rate. All right. Next is tax liability. Okay. This is essentially just a term explaining, or this is a term encompassing all the taxes you pay. Okay. So this is state tax, federal tax, city tax, county tax, licensing fees, etc. All right. This is all the taxes that you pay. All right. Tax deferment. This is to postpone or delay payments related to real estate transactions or any kind of transaction really for future years. Okay. Real estate is highly advantaged in this field. Okay. And a great real estate investor will go their entire lives deferring taxes and never paying them. That's kind of the goal. All right. Depreciation. Normally the most powerful saving tool in the real estate investor's tool belt. So we're going to dive pretty deep into this next week. But it's essentially saying that your home is losing value and so you incurred a loss. Okay. Here's a more detailed example or detailed definition. All right. And it's basically saying your home is deteriorating, therefore you're losing money or you're losing value. And you can write it off on your taxes. All right. Tangible useful life. The IRS has predefined the time periods over which different assets can be depreciated. They assume it to be 27.5 years for your home, but it can be more for commercial. And you can also, this is straight line depreciation. You can also use bonus depreciation and accelerated depreciation, which we'll go over next week. All right. And lastly is tangible property. Okay. Tangible property is the home itself on the property. Untangible property would be the land underneath it. Okay. You can only write off the loss of the tangible property because the land itself doesn't lose value, right? It doesn't deteriorate. It's land. So that's an important concept to understand. And that brings us to the end of the first week. Sorry, I rushed through that second half there, but it is a lot. The tax code is extremely complicated. I hope it wasn't too dry. I hope the weird images at least spiced it up a little bit. But yeah, as you can tell, U.S. tax code is not a simple thing. In these strategies, to understand these strategies, you need to have that background in terms and concepts. So thanks for staying through the whole thing, and thanks for letting me present on this.
That was awesome class. I didn't even notice the time. I looked up and I was like, holy crap.
Yeah, thanks. Appreciate it.
Lots of great information. A couple of things I just want to say was like you said at the very beginning, how you can win clients by sharing that knowledge. Like sure, you're not gonna be the one like doing the taxes for them, but you'll be able to point them in the right direction. And when they actually take you up on the advice that you're giving them, hey, you need to look into how this tax benefit can help your particular situation, and then they do it and they see the results, they're going to be telling all their family and friends, like, this guy, my realtor Nick, told me about this, saved me a ton of money. He's awesome. You got to talk to him. And yeah, it'll really benefit you. And then something you're saying when you're talking about the buckets made me think about it. I like to think of everything in metaphors, and it's like particularly metaphors that have to do with working out. And so like you hear everybody say like your physical fitness is 10% actually working out and 90% diet, or whatever ratio they want to use. And I think tax knowledge is similar to that. So you can, just like with working out, you can work out 16 hours a day and you're going to be light years behind in physical fitness compared to where you would be if you don't eat properly. If you're just eating junk food, you're just going to be a mess. Similarly with not knowing about taxes, if you can work and invest and do all these crazy things that you're doing, but if you don't understand taxes, you're missing out on a monumental amount of money that you could be saving and then putting towards other investments and have a exponential impact on your business.
Yeah. I think it was Robert Kiyosaki that said, it's not the amount of money you make, it's the amount of money you keep. And that's huge. And to think that, like, if you work say you make $100,000 in a year at your W-2 job, and then to think you lose 50,000 of that to taxes is just absurd to me. So luckily we work in a field that is very tax advantaged. And so keep as much money as you can. Honestly, I don't want to work anymore for the government. I've done my time.
Yeah.
I want to use that money for my own stuff now.
Yeah, definitely. And it's stuff that like, a lot of the stuff you went over today was the key terms, and
Mm-hmm.
if we build it into our daily habits instead of
Yes.
give maybe 10% of our social media scrolling time towards learning new key terms for taxes, and
Mhm.
within a year you'll be you know 10 times more knowledgeable on taxes than you were the previous year.
Yeah, and I know it was a lot of stuff. I really had to rush through it there at the end. The U.S. tax code and tax strategies. I mean, we could spend an entire year on that subject, just getting into the weeds. I just wanted to brush over the general concepts and give the tools for everyone else to go out and figure out their own strategies, or at least understand these strategies and be able to employ them. Um, were there
Uh,
any questions about like anything, any of the terms or concepts? I guess was anything like unclear? I'll give people a second to type or speak up.
No, Nick, it was really good. I would just be curious to open it up to the group to hear if anybody has any strategies that they've employed kind of in their own experiences that they've found have really benefited their tax situation. You mentioned the CPA, but
Yep.
is anybody else using other strategies that have helped them kind of build and develop their business?
Yeah. I've used actually a few of these. This isn't. I know, like the last one I did, I was like, I've never used creative financing in my life. I'm totally talking metaphorically here. The tax strategies I have used. The 2 year live in flip. I've actually done that in real life. It has saved me tens of thousands of dollars in taxes. Um, Keeping receipts and writing off all business expenses. Like I said, I wrote off my wingsuit. That's that was pretty expensive. Same for my automobiles. I have three of them. You know, so yeah, this is a very real thing. Depreciation too. We'll go over that next week. I've used that as well. They're all very real strategies that can save you a ton of money. I hope, yeah, everyone in here is going to use them in the future.
did you get that idea of writing off your wingsuit from your tax accountant, or was that something you
Nope.
researched?
Other wingsuiters. Uh,
Nice.
yeah, I saw other. So you can be like sponsored. I'm not good enough to be sponsored, right? So I sponsor myself. Um, but yeah, you go to the drop zone, you'll see dudes with the customized wingsuits, and they'll have business logos on them, and either they're sponsored or they sponsor themselves. And if you sponsor yourself, it's a tax write-off. Like if your business sponsors you, it's advertising.
Yeah.
So yeah, I'm not by any means the first one to think of it. Plenty of other people do it, and I'm sure people do it for other hobbies as well. It'd be pretty cool to put a business logo on a surfboard for people that really enjoy surfing, like out in Hawaii. Might even get you a client. Who knows? um,
I was talking with a realtor at an open house recently, and he was saying how because the house that he was listing was his own property that he was selling, and he was telling me how he was talking to his tax accountant, and because he'll bring like before the tax year is up, he'll bring his documents and stuff and say like, what can I do to improve my how it's going to look when the tax return comes in, and the tax accountant told him to buy like he could buy like a $80,000 truck. So he got a brand new
yep,
Rivian.
yep,
And so because that truck is used for his business to move stuff around, then he was able to write off that entire $80,000 electric truck. Pretty crazy.
yep. Yeah, I had a friend just do that as well. Yeah, write off your vehicles. Call them all business vehicles. So, and also your gas and your maintenance as well. Those really add up. And there's even mileage trackers that you can use for being a real estate agent, because agents drive a lot from house to house.
Yeah. So something that I've heard of and use, but don't fully understand is the writing off the so you get your BH, which is not taxed, and then you can write off the property taxes, right? For your and
yeah, you can
write off the interest.
Yep. So your federal, your property taxes that you pay for like local property taxes at the county or city level, you can write those off on your income taxes at the state and federal level. So that's huge
right?
for, I'm sorry?
And your interest on your mortgage?
Interest on your mortgage. Yep. That's another big write-off. So if you're like me and you live in California where property taxes and mortgage taxes are, mortgage interest rates are insane. That is a huge, huge chunk of your income that you can write off. So yeah, and
yes, that's a topic I need to research more, because I bring it up with clients. I tell them like your BH is not taxed, and when you go to pay your mortgage, and if your mortgage is right there near your BH, you're getting a tax write off on money that's not even being taxed. So it's kind of like a double benefit.
Yeah, it's really cool too when your tenants are the ones paying your mortgage interest rates, and then you get the tax benefit for it. I like that one. But yeah, this job and the military in general is very tax advantaged. And honestly, I heard someone explain it earlier. Like even if you're a patriot, it's more of a patriotic duty to not pay taxes, because if you're not paying taxes but you're still making money, well, that means you're doing activities that the government is incentivizing. So that's things they want you to do. They want you to do things like own real estate and rent it out, because I mean, for one thing, our founding fathers were landlords, but two, you're providing housing. You're providing a necessary to life function. So they're not going to tax the crap out of that. They want to make that as profitable as possible. So you're really doing your patriotic duty by not paying taxes.
Yeah.
At least that's what I tell myself.
Yeah. As it grows and you maybe have like a full-time cleaner that's cleaning all of the house.
Yep. Yeah, exactly.
Yep.
Yeah. So they don't want to, they want to incentivize certain behaviors. And if you are doing those behaviors, you will be rewarded, just like the tax credits we talked about earlier.
Awesome. Well, thanks a lot, Nick. Thank you everyone for attending. I know we're all looking forward to the part 2 of this topic.
Can't wait.
But going to go ahead and wrap up the meeting, and I'll stick around for a few more minutes for any other questions.